Good afternoon. I'm Peter Lopresti, proud founder of the Stoic Team. Today is Thursday, April 16th, 2026, and we have a special guest with us. We have Diego Acuña, the founder of DA Business Management Incorporation. He came from the IRS as an IRS auditor, and he currently maintains his enrolled agent status with the IRS. We are extremely happy to have you with us, Diego. So please go ahead and introduce yourself to our listeners.
Thank you for having me, Peter. Afternoon, everyone. My name is Diego Acuña. Like Peter mentioned, I'm an enrolled agent, licensed by the IRS. Out of college, I got the opportunity to, start my career with the IRS. I was a tax auditor, pretty much, the dark side, like a lot of people like to call it. In 2016, I decided I came into a point in my career where I either decided to stay with the IRS or I just, decided to leave. And I decided, I'm better off, serving my community, and pretty much serving you guys and, helping out, the little person in the world, right? Compared to, working for the IRS and continuing to be hated and, not liked. So yeah, ever since 2016, I founded DA Business Management, and I've been serving the community, by providing accounting and bookkeeping services, tax preparation, audit representation for clients that are being audited, and tax planning, which is something we're going to talk about today, which I'm excited to dive into.
Thank you so much, Diego. We're very excited to get into it. On to Peter Georgitis, who is joining us, again, a founder of the Stoic Team, our preferred lender at Preferred Rate. And so, Peter, thank you so much for joining us.
Thank you, guys, for the opportunity. Yes, this is Peter Georgitis from Preferred Rate, founding member of the Stoic Team. Thank you for inviting me.
Cody Williams, he is a short-term rental specialist on the Stoic Team. And so, Cody, please introduce yourself.
Hi, thank you so much, Peter. As you said, I manage our short-term and mid-term operations over here at the Stoic Team. Right now, we have probably around 10 or 12 under management right now, with another 6 to 8 in the pipeline to open in the coming year. It's been a very fun ride of crunching numbers and figuring out which properties are profitable, who to work with, what makes the most sense and what direction to go to in the next 2-3 years. But anything related to short-term rentals and mid-term rentals, I handle.
Absolutely, Cody, and thank you so much for that. We appreciate your expertise. And again, one of the reasons why we have Diego with us today is related to this analysis of where does it make sense to make an Airbnb? When does it make sense to have an Airbnb versus a traditional rental? And of course, all the different tax implications of all these decisions that we make. So, Diego, if you could perhaps just introduce everyone some of the changes that a lot of our clients are taking advantage of over the last few years in terms of the depreciation schedule of these investments and what that really means for someone who is, let's say, a W-2 employee, has a great salary, but also has perhaps an even greater tax obligation at the end of the year. So we'd love to hear about some Stoic strategies that you have to offer them.
Perfect. Yeah. So pretty much, as you, like Peter mentioned, right, there are people out there, high W-2 earners that really, at the end of the day, don't really get a lot of tax savings or a lot of tax benefits like business owners do, right? So, as an investor, business owner, there is a lot of great, tax incentives that, that you can take advantage of. One of them is, short-term rentals, long-term rentals. So as a W-2, high-income W-2 earner, you can say, a way to benefit. And what I like to say is, playing chess with the IRS. Where you basically keep a lot of your money, and instead of giving it to them as far as them taking out of your paycheck and paying high payroll taxes, it basically is just investing it in real estate, taking advantage of that, appreciating or benefiting of not only the cash flow of rental properties, whether it's short term or long term, but also benefiting in the long term wealth, right? That W-2 is not going to last forever, right? And, if you're not wise with your investments, your 401k is only going to go so far. Your pension is only going to go so far. Your social security is only going to go so far. So, the goal with my clients is just to help them grow their net worth, right? And at the same time, pretty much lowering their tax burden to, eliminating it altogether, or, cutting it in half or cutting it by a quarter. It really just depends on, each individual and what they're comfortable with, and, how much capital they have to invest. And basically, just pretty much getting your foot in the door and taking advantage of these great, tax write-offs that, the average person doesn't really, take advantage of, because it's something we're not taught in school. In high school, in college, we're not taught to be entrepreneurs, right? We're not taught to, invest in real estate. We're not taught to, think outside the box, right? They teach us to, just be a worker bee your whole life and take advantage of, hopefully, work for someone. And by the time that it's time to retire, hopefully you have enough in your retirement to, to live comfortably. But as you know, that's generally not the case, and, main point is just quality of life, right? When you're a W-2 worker, you're burnt out. You basically work for someone else. So you don't really have that, that liberty of basically, taking time off, when you want, right? Spending time with your family, spending time with your loved ones, or, whatever you want to spend your time, doing, blessing others, giving back to the community. So, investing in real estate really allows you, I think, to have that better quality of life, and gives you that liberty to basically do what you want to do with your free time,
Absolutely. No, absolutely. No, I cannot agree more with you. It is so important to get right now, if you work for a living, right? So if you weren't born independently wealthy, 80% of your family's net worth comes from the home that you live in. And to be honest, if you look at and you change at the net worth of people who are landlords, people who own not just where they live, but also other buildings, it's much higher. It's much higher than that. And so it really is a situation where getting on the property ladder just makes so much sense as an individual, but to get on it from an investment perspective, to be able to remove some tax obligation, essentially, with these tactics, I've seen people essentially take what was a income tax payment and just take that amount of money and use it as a down payment on an investment property. And if you do the taxes correctly with the strategies that Diego is able to do for his clients, you're able to use a significant amount of those, basically of the value of the structure, not the land, to be able to then go back and offset your other income, right? So Diego, I know a lot of people talk about maximum 30%, and there's a lot of, let's say, misunderstanding or just questions around it. So what you hear is that you can bonus depreciate up to 30% of whatever you buy. But I know we had a little bit of a conversation before this podcast to try to understand a little bit better. And, I was very surprised to learn that it's not 30% of the purchase price. It's 30% of the structure that can be depreciated. And then again, it's not even necessarily so much the purchase price, but the actual value of the asset that you're going to be depreciating as well. Is that correct?
Yeah, it's the building value that you basically get to depreciate, because land is not depreciable. Land is just land. So, really when you're investing and you're going to take advantage of these tax strategies, it's finding a property that has building value in it, or, finding a property that has some building value where you'll benefit, but you can also force appreciation to it by any property that you repair, that you rehab, right? Whatever you put into it, that adds to your building value as well. So,
absolutely. So let's say for example, just so people could understand with numbers, let's say if I were a family, and between both spouses, somewhere between $300,000 and $500,000 a year coming in. Usually your income tax bracket would be somewhere in the high 20s, I'm guessing, something like that.
Yeah, I mean, it varies on the individual. It varies, where you at on the state as well. So I'm in California, high tax bracket, people in New York, high tax bracket, Chicago, you guys also pay state taxes, right? So generally, someone making that amount, you're probably in the, mid to high 30s, I would say, tax bracket wise of what you're going to pay to the IRS and state. So yeah, you're pretty much there. The average American is in 20s, but those higher income earners, they're in the 30s, sometimes even 40% from what I've seen.
And so we're seeing, let's say a family that's making combined maybe 150 or 200,000, right? They're having a tax obligation of between $80 and $120,000. I mean, it's a significant amount of money that you're paying every single year. So let's just, if we looked at this from a structural perspective, if they took that 100,000, and I know that Peter was talking to us that he has a program for investors, 15% down for a 2-unit building. And so if let's say they took that, 150,000, use it as 15% down, and let's say a $800,000 building, or property, right? Like a 2-unit building. And just for purposes, let's say that the 2-unit building cost, 800,000, and let's make the 2-unit cost 600,000, so that then you'd have to put down about 90,000 if you did 15% down, right? If you did that, and if they did the analysis of it, and let's say the land were worth around 100,000, and the actual building itself was worth around 500,000. What would be the amount roughly? Or let's say, like, of course you can't get to a specific number, it's specific on everyone's taxes, but let's say if people could kind of understand just, in a broad perspective, what is possible in terms of the realms of those limits.
So before we get into that, I'll kind of just, give you guys kind of a little backstory, or, a little bit of a, lesson of how we're taxed in the United States, right?
Mm-hmm.
So our taxes is taxed combined, right? Pretty much all our income is taxed all at once. However, though, it's broken down into 3 categories. One being active income, right, or ordinary income, and that is, your W-2, your 1099. If you're a business owner, depending on how you're structured, your K-1s, any interest income you make from the bank. All that is active income according to the IRS, right? Then you get into category number 2, which is your capital income or portfolio income, right? If you have stocks and bonds that you sell, if you're, trading a little bit here and there, kind of on the spare time, that is capital or portfolio income. And then we run into the real estate side, which is your passive income, right? So, long-term rentals, or even if you're a business owner, but you're a passive investor, right? You get a passive K-1, right? So those 3 incomes combined, right, are taxed cumulatively all at once. However, though, you could only offset, right, active with active, portfolio with portfolio, and passive with passive. So, if you are fresh into real estate thinking, oh, I'm going to go buy a rental property, right? Technically, that's a passive activity. You can't offset that passive activity with any of your ordinary income. So if you have a W-2, your wife has a W-2, right? You can't offset that, those losses that you generally get from the rental. Now, that doesn't necessarily mean you can never take it. What the IRS does, or on your tax return, what happens is those losses get suspended. And the only time that you can take those suspended losses is when you dispose or you sell of the property. So that's not the case that you want to, you don't want to hold your head on that, right? Of, oh, I'm going to take these losses when I sell, because the goal is to never sell, right? Because now you have capital gains to take into account, right? And yeah, if you've had that property for so long, you probably have a lot of losses accumulated. But once again, the goal is not to sell. The goal is to accumulate and eventually live off of your properties, live off of that rental income, right? So that's kind of just a little backstory of kind of how we're taxed in the U.S. So with that, now comes the tax planning of the strategy side of it, right? What avenue am I going to go with? Am I going to go the short-term rental route, or am I going to go the long-term rental route, right? And generally, for someone new, investing into real estate, the easiest and the most beneficial is to go the short-term rental route, because that's where you're going to benefit the most. And it's, I'll get into it in a little bit when we, touch on the topic, but basically short-term rentals are considered an active activity, even though, you might buy that property and go through the whole lending process the traditional way, right? Short-term rentals are considered an active activity, ordinary activity. So that is going to offset any type of ordinary income that you have coming in through the year.
Excellent explanation. Thank you so much, Diego. And so absolutely. So essentially, by acquiring this new property, right, and then being able to, essentially harvest the losses of this property all in the first year of the acquisition, you're able to go ahead and basically just decrease the amount of paper income that you're offsetting your income with these depreciation, essentially. And so that's how you're able to drastically decrease your amount of income taxes that you own, ideally enough that you can subsidize substantially the acquisition of investment property. Now, I love the fact that you talked about the different types of requirements in terms of passive and active management. So Cody, I know that we have several different models. Of course, we have a partnership model with the people who we manage for, where of course the person who owns the property is having the end all be all decision. So the 51% of the management of the property, but we do a lesser amount in the percentage, but we take care of, let's say, the more time sensitive, the more, let's say, critical and most importantly headaches type of things, right? So we're trying to essentially have a partnership of management where we're able to do the headaches, and we're having the owner spend their time doing the things that really owners should be doing, making these executive decisions, perhaps communication with the clients and the tenants that we work with. But I'll let Cody go ahead and describe this relationship. I'm very proud to have been a paid consultant on the creation of the co-hosting platform for Airbnb, so I'm very familiar with this. But Cody is for the last 2 years been taking over 100% of the short-term rentals, and so he'll be able to let you know what it's like to do it nowadays as opposed to when I was doing it 15 years ago.
Absolutely. And so, 15 years ago, the landscape is very, very different today than it was back then. And so, that 49%, let's talk about that, right? What does that embroider? So one is if you have multiple properties, eventually I'm sure you want to get these onto multiple platforms. However, the issue that you're going to face is double bookings and your prices not being consistent amongst every single platform that you're listed on. And so one of those things is going to be a property management software. And with those PMS softwares, this is one of those headaches that 59% is a part of. Tying this whole puzzle together, figuring out how to make sure there's not a double booking happening, making sure those prices are all synced together, and then making sure that it's profitable year round with pricing strategy. So all of this comes into play with making sure that the 49% is taken care of. On your 51%, you can again manage. You're able to manage your conversations with all of these guests. You're able to get the check, but the stressful part is taken care of on the lesser end. But there's many things, even those 2 a.m. phone calls, you're not getting. That's that phone call. Hey, there's no hot water in this Airbnb. What's going on? That's on that 49%.
Thank you so much, Cody. And so, Diego, could you perhaps explain a little bit or do some education for our listeners and for us as well, really? Let's say why is there a difference between active managing and passive managing? And then also, is there a difference if you're doing short-term rental versus a traditional rental?
Yeah, so the IRS requires that you as the investor do the majority of the investing, or not the investing, excuse me, of the management. So the IRS requires that you do 51% of the managing. Now that doesn't necessarily mean that you can't have help, like Cody mentioned. Where they do the 49% is you just have to provide more time, right? And those numbers can vary from talking to your property management company to you also handling some of the work, right? Of course, you're talking to Peter, as far as lending, right? So all of these conversations basically, all of the time spent basically has to be documented. So creating some type of log, I know there's a bunch of apps that, that you can track your time, just like we track our miles on our vehicles, right? The same way we have to track our time spent, when it comes to, managing these properties, right? Now, the goal is eventually to be what the IRS considers or classifies as a real estate professional, right? So when you're a real estate professional, the IRS only requires you to manage the properties or to keep track of 750 hours throughout the whole year, right? Now, not necessarily 750 hours each property, but once you have a few properties under your belt, then you can group all those properties into one activity, and you just have to meet 750 hours, right? Which, for that W-2 person, unless, like I said, you have a stay-at-home wife, or your partner doesn't work or works part-time, they can qualify as a real estate professional. That's fine. But in today's society, unfortunately, right, both spouses work, right? Just because it's not like our past generations, our parents, the father would go to work, and the mom would stay at home and take care of the household and take care of the kids, right? That's really pretty difficult nowadays, right? So the goal that we're going to talk about here, the goal that I help my clients out with, is to over time class or qualify as a real estate professional. However, though, in the beginning, it's pretty difficult, like I said, unless one spouse doesn't work or is a stay-at-home, mom or dad, you can say. So pretty much, the way to get your foot in the door in the beginning is the short-term rental route, because short-term rentals, the IRS only requires you to manage it for 100 hours throughout the year, which you break that down, that's about 2 weeks, right? So when it comes to strategy, right, you could technically, if you want, right, not buy that rental property till, the last quarter of the year, right? And then just manage it for 100 hours, and then, you're good. You do the cost segregation, get the depreciation of it, right? So it really just depends on the individual, right? Really, it's always great to, to be profitable with Airbnb, right? That's the goal, right? However, though, pretty much when you're investing, don't get caught on or don't get too caught up in, the profitability of that Airbnb. It's really, you're buying that property just for that tax break, right? And then next year, right, as more income comes in, right, you buy another Airbnb or short-term rental Airbnb, right? So, in the beginning, it's really just for the tax breaks that we do it, because that's what's really going to offset your income, right? Instead of you, paying those payroll taxes, paying, those quarterly estimated taxes to the IRS or to the state, you're basically now, taking depreciation, and that's kind of like your trump card, right, to lowering your tax bill or even eliminating it altogether, which usually happens with my clients, depending on, what type of property they buy and how many they buy, right? Once again, tax planning, it's catered to you, right? It's not general advice, right? Because, I might be comfortable with, swinging for the fences and hitting, buying an apartment building, right? Some people might not be comfortable with that. They might just want to start with, a single family home or a condominium or whatever it is where you can do Airbnb, right? So when it comes to tax planning, it really just, it's catered to you, right? I work with my clients, and I cater a plan that fits their needs, right? Because, depending on whether they're married, they have kids, and what they got going on in life, right? I really want to set them up for success instead of just, setting them up for failure and telling them, hey, you can do this, but realistically, is that even possible? And, sometimes it's not, right? So it's sitting down, crunching the numbers, right? Seeing what you're comfortable with, how much time you have to, to throw at this, right? But when it happens, it's a beautiful thing, right? When it all comes together, it's beautiful, because people realize, wow, instead of me giving the money to the government, I'm investing in myself and in my family, and in my kids, right? Whatever your why is, basically, that's what I help my clients do, is give them their why, right? Or point out that why, so they can then invest it and really just live a better lifestyle.
Absolutely. And so again, with this co-hosting platform on Airbnb, the way that it works is that us, Cody and myself, the Stoic team, we do, a lot of the in-person minor stuff, again, the stuff that's very difficult. But again, because it's a co-hosting platform, the owner of the property who participates actively in the management, they're able to see all the messages in real time as we do. They're able to chime in and if someone asks a question, they can just say, hey, I'm the owner and this is what I say. We love that. When the owner says this is what goes, we don't have any guesswork to do, right? And again, talking about that 51 versus 49%, some people, they don't understand, like, how could it be that, let's say maybe I'm located in California, but I can have a property in Chicago and do short-term rental and be profitable and actively management. A good example that I like to do is that, we coordinate putting together the furniture, but the owner generally is the one who picks out the furniture, orders the furniture, make sure it gets delivered to the property. And believe it or not, if you keep track of time, the person who coordinates all that work actually spends more time than the people just setting it up and putting it together. And so it's kind of a good little example of how the division of labor works in management, remotely especially. Now, Peter, I'd love for you to talk a little bit about, a lot of people are worried about how could I maybe qualify for this property, right? Like, I have enough for the down payment, but I'm worried about my income, especially since I'm going to be writing off some property, how are they going to qualify for these multi-unit properties that we're talking about? Or same thing too, or even if it's not a multi-unit, if it's just a condo, how does it work?
Okay. So I have a question for you, Dale. If you are buying a 4-unit owner occupied, and I've come to Peter Lopresti and his group to do management for me, and I want to do an Airbnb on 3 of my units. I'm occupying 1 and renting out 3, but I decided to do short-term rentals. Do I still get the same tax benefits?
So that cost segregation study that you're going to do on that is going to be based off of the 3. So
right.
So let's just say that each door costs $100,000, for example, right? Building value, right? Once again, taking off the land, then you can and that, let's just say, just to use easy numbers, so you're so the people hearing can understand. Let's just say it costs you $400,000, right? And you decide to do Airbnb for 3 of the units, right? You're only going to do the cost seg based off of the 3 units, right? That occupied unit won't qualify.
Sure.
Yeah,
but
something I want to point out really quick.
Sorry?
Something really important that I want to point out very quickly is, while I think this still applies, it's very important to understand here in Chicago, it's illegal to have three units in a 2 to 4 unit building as an Airbnb. So only one of those units would be able to be an Airbnb. The other units, at most, if you want to go beyond traditional 12-month rental, would be midterm, which can make 20 to 40% more in revenue. But that is like the next level. So it's usually one, if you got a 3 to 4 unit building or even a 2 unit building, you do one of those units as an Airbnb, usually your best one, and then the other is a midterm. And then if you got 3 to 4 units, then it's 1 Airbnb, 1 midterm, and then the other 2 are traditional rentals. It's usually the best part.
Well, the reason
I just want to clarify a little bit too. You are able to do it in Chicago, but you need to have a commissioner's adjustment, and it's easier to just win the lottery and not have to do any work. So
Yes, as somebody who has gone after a commissioner's adjustment as well and lost 3 times, yes, that is true. Additionally, if your property is 5 units or more as well, then you can do a percentage of how many units are in the building. So if it's a 5-unit building, it's 1. If it's 6, I believe it's 2 at that point.
So, Peter, to answer your initial question, the reason why I wanted to divert that question, because on Freddie Mac, you can buy a 4-unit building, owner occupied, with 5% down, and then of course
even technically 3.5% really. So I mean, this is a super interesting situation. So I mean, you can acquire.
FHA,
go ahead, Peter. I like where you're going with this. I like this.
So the point I'm trying to make is that in terms of talking about how what's the minimum down payment. So as an investor on a condo, single family home, and there's some programs of a 2-unit, you can go with 15% down. Traditionally, they're 25% down on a 2 to 4 unit Fannie and Freddie, but there are some programs that go 15 on the 2. But going back to the original questions, I see this podcast more talking about short-term rentals and how people could benefit with short-term rentals rather than traditional. Because it also sounds like, as you were talking about earlier, Diego, that someone can do, seems like for some reason the IRS guidelines benefit people who do short-term. Did I understood you correctly when you mentioned that earlier?
No, so so someone who doesn't have much time, right? Investing in short-term rental is the easiest because of the hour requirement. You only need to
I'm sorry.
manage it for 100 hours, right?
Sure.
Now the goal, once you have a couple properties under your belt, now you qualify as that real estate professional, right? And now all of your properties offset each other, and all of your income offsets with the properties, right? So being classifying or qualifying as a real estate professional is pretty much the long-term goal. Now, there might be clients that already have properties, right? And they might, already qualify as a real estate professional. That's something that, I help them analyze because unfortunately, right, your preparer might not be, reporting those properties on your return the correct way, right? You might already, if you have 4 or 5 properties and you're managing them yourself, that's not a passive activity. That's technically an active activity, right? Right. So, whether you do short-term or long-term, you're still going to, do the, cost segregation study, which gives you anywhere between 20 to 30% of a deduction, or you're basically accelerating that depreciation based off of the value. So yeah, it's just short-term rentals are just, if you're just, for that novice investor starting off, right? It's just the easy, it's easier, to do that because of the hour requirement, right? So yeah.
Okay, I'm sorry.
Yeah,
I misread that.
No, I think I understand it. Let me try to do a master synthesis and see if this works. So what Peter G is recommending, or what could be possible, would be to purchase, what's the maximum? Is it $1 million for FHA 4 unit, or is it 900? Let me see.
Hold on.
FHA 4 unit loan limit. Let me see what it is. It's $1 million now. Yeah, so it's $1,041,000 everywhere in the United States. So at that point, that means that you could get a $1 million property for $35,000 down, assuming that the seller pays for your closing costs. Let's say that of the $1 million, $200,000 is in the land, and then maybe of the 4 units, they're all the same, and so they're each worth around $200,000. So we would be able to get $600,000 would be essentially, and now again, I do want to confirm this with you as well, Diego. We're just doing back of the envelope math based on what we paid for it. If we had a true appraiser come out and we did some minimal work and they said, actually, it's not worth 1 million, it's worth 1.2, then all of a sudden for that year, you're using 1.2 as your basis instead of 1, correct?
Correct. Well, you got to subtract the land, right?
So of course,
Right.
yes.
Right.
Yeah, I've always subtract the land, but I mean that if you paid less than what it's worth and you're willing to pay an appraiser to certify that extra value, you can go ahead and bonus appreciate that extra value. And so let's say even then, let's not count that. So let's say $600,000, and we can do maximum 30% of that. So we're talking about almost $200,000. And
depreciation?
again, yeah, $200,000 in bonus depreciation off of that $1 million acquisition. Again, only looking at the 3 non-occupying units and not looking at the land. But that represents around a $200,000. And so again, I mean, if someone is in a 20% tax rate, right? So if someone's in a 20% tax rate, that means that if you put in $35,000, you would save $60,000 in taxes for that year appropriately. So you would actually not just take your $35,000 and not pay them in taxes. You would not pay $60,000, and of that $60,000, you'd only take $35,000 and purchase this property. So I mean, a way to make money while acquiring real estate, Diego. I mean, I think you can see why I'm very excited about this, and lots of our listeners are very much looking forward to this podcast, right?
Absolutely.
Yeah. So I mean, yeah. Right. And then of course, and again, to be able to get for this qualification, you could, again, just do short-term rental, call it short-term rental. Then you only have to do 100 hours of contributing. We're talking about 2 hours a week. And, as efficient as Cody and I are with our help of the management, you're definitely going to get to 2 hours a week, unfortunately, looking over the messages and doing everything else. And so it really is just an amazing opportunity, right? To be able to save $60,000 and only use $35,000 to acquire the property, and just, have an extra $25,000 for furniture or initial setup costs, right? It's an amazingly powerful strategy. And so, of course, again, I see as we only have 4 minutes left, so I do want to again thank Diego, right, to be able to join us, to be able to share this with our Stoic strategies. This is the most requested topic. We have never, we've always proactively done Stoic strategies, and then just, people will find them. We have had several of our clients reach out to us to ask us how this works. And so, Diego, if you could let them know how they can contact you, right? So, I mean, obviously, working with you to be able to encapsulate all of their tax needs is a really important part of their tax strategy, to be able to have their tax planning. So, what would be the best way for our clients, and I think myself as well, to get in contact with you after this as well?
Yeah, thank you guys for having me. First of all, it's been a pleasure and an honor to share my knowledge with you guys, and thank you for inviting me. But a couple ways to get in touch with me. One by phone. So I'll give you guys my direct number. It's area code 818-939-9129. That is the easiest and most efficient way, just because sometimes emails you get boggled down, right? Instead of as an accountant, clients are constantly calling me, hey, Diego, especially now during tax time, right?
Yes.
The tax deadline was yesterday. So, they're always, calling late night or whatever it might be, right? So phone is the best way to get in contact with me, or by email, Acuña Diego EA@gmail.com. But, you guys could also, get my information from Peter, both Peters actually, and just to, give them a shout out, they both helped me with my rental property, not rental, actually, yeah, rental property. The property we bought in Chicago, a condo in the Gold Coast back in 2024. And they've been great. Just for anyone you guys know, Peter basically, helped me from finding the location. Peter G helped me with the lending, and and then Peter also helped me find a tenant. So they basically made it super easy for me and my wife to pretty much, just take a step back and, let them kind of do what they do. They're professionals, and, they found us a great tenant, in a quick matter of months, and it was during the wintertime too. So, which makes it, made it, a little bit more difficult, and now Cody, is helping us, our tenants are moving out, so now Cody and Peter are also helping us find a new tenant, and, don't doubt that they will. So, for all you guys out there, these guys are great. They're professional. They know what they're doing, and, they really make it super easy to work with them. So, highly recommend that you guys, give them a call.
Well, thank you so much for your time, Diego. Yeah, I know we're gonna have, based on the feedback, I think we're gonna have other Stoic strategies that are gonna be based on tax strategies, and so we very much appreciate your time, Diego, and we hope that you could become a regular on our podcast. And of course, Cody, thank you so much for your time as well.
Absolutely, thank you.
Just Cody, he physically isn't in Chicago right now. He's actually in Indianapolis. He's in the process of onboarding 75 short-term rentals in Indianapolis, and so it's a very exciting time at the Stoic team. It's very exciting to see all of our clients grow and have all of us grow together. And of course, Peter Georgitis, he is the preferred lender on the team. He is the one that makes all the magic work. And again, he's extremely flexible, very easy. Again, he's able to come up with all these different mortgage products. As you can tell, which mortgage product you use, right? I was talking about $120,000 down. We're able to find the same way with only $35,000 down, right? So you can save even more money on your taxes. And so, Peter, if you'd like to share perhaps your phone number, your email, so people would be able to get in contact with you.
Appreciate that, Peter. My phone number is 630-854-7811, 630-854-7811. And my email address is peter@preferredrate.com.
Perfect. And then Cody, what's the best way for people to get in contact with you? I know that you offer complimentary analysis in terms of what the potential income can be for these different properties for anyone who's looking to convert an existing property to a short-term rental, or of course, if you're looking to write an offer on a building, having the information of how much money you'll make on Airbnb is a nice little piece of information to have that your competitors usually don't have access to.
Absolutely. I could be reached at 224-247-3321. And my email, I can be reached at Cody, that is COTY, at thestoicteam.com.
Perfect. Thank you so much. And everyone, of course, I'm Peter Lopresti. I'm the lead realtor here on the team. And again, my number is 224-595-2339. Feel free to call or text me if you'd like an introduction to any of the Stoic team members. We are extremely happy to help you, right? If you're at the start of your search, or you're been doing this for 10 or 20 years and you're kind of ready to partner with someone a little more professional to make your life easier, we're here for that as well. So again, Diego, Peter, and Cody, thank you so much for your time. Thank you for a very special episode of the Stoic Strategies. And again, Diego, coming the day after tax day, this is dedication. This is the type of people that you want to work with, everyone. And so, you know, even though he's come through the ringer and he's still here telling us about how to get prepared for a year from yesterday, right? So thank you again, Diego, and to all of us listening, thank you for your time.
Take care. Thank you. Bye-bye.
Bye.